Imagine you were the neighborhood's only pizza oven for years. Everyone came to you. Then two new, fancier ovens roll into town, Dell and HPE. They sell pizzas cheaper, and suddenly you're cut from only game in town to compete on price, quick. That's Supermicro Computer, SMCI, right now, once dominant in AI servers, now facing fierce competition that is ripping at pricing and margins. Supermicro once dominated AI server boxes but is now squeezed by Dell and HPE stepping into AI infrastructure, and that's pressuring prices and margins. Management still calls for $36 billion in revenue for fiscal 2026, citing a massive order book in Blackwell Ultra orders. It's a bold target that assumes execution and healthy pricing. Quick background: how Supermicro rose to prominence in AI servers. Supermicro's rise was a classic tale of product-market fit. The company built flexible server platforms and embraced rapid design cycles that made it extremely attractive to hyperscalers, cloud-native companies, and GPU-heavy AI customers. SMCI optimized for density, cooling, and integration with accelerators, the stuff that made training and inferencing clusters hum. For a few years, that agility translated into outsized share gains in the cutting-edge AI server segment. But the industry doesn't sit still. Incumbents, Dell, HPE, Lenovo, and system integrators started to chase the same opportunity with far more balance sheet heft and enterprise relationships, and the vendor landscape shifted. The result: a more crowded market where pricing became competitive and the first-mover advantage eroded. The $36 billion call, ambition or bravado? SMCI management publicly projected a strikingly large target, at least $36 billion in revenue for fiscal 2026, rooted in a multi-billion-dollar order book and substantial commitments for systems like NVIDIA's Blackwell Ultra deployments. That figure, on its face, is a bullish growth forecast that suggests substantial backlog conversion and execution across manufacturing, supply chain, and fulfillment. It's the sort of target that makes bulls salivate and bears ask for receipts. Why the skepticism? Because hitting $36 billion requires turning orders into shipped systems while navigating a market where prices may reset downward due to competition. If SMCI has to keep lowering prices to preserve share, hitting revenue targets becomes a treadmill. Revenue could rise, but margins shrink, and shareholders care a lot about margins. So the $36 billion figure is a double-edged sword, great for top-line growth narratives, but risky if it masks margin erosion. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. The margin story, from healthy to squeezed. The headline that makes CFOs wince: gross margin dropped to 9.3% in Q1 FY26 from 13.1% in Q1 FY25. That decline is not trivial. It reflects multiple factors: pricing pressure to maintain or grow share as Dell and HPE ramp similar AI server offerings. SMCI has slashed prices on some systems, hurting margin. Higher mix of lower margin configurations. Large AI systems can be lower margin if customers demand commoditized designs or negotiate hard on price. Cost inflation and memory pricing. Memory, DRAM/HBM, and other component costs affect gross margin volatility. When component prices spike, suppliers that can't pass costs to buyers see margins compress. A gross margin in the low single digits for a hardware reseller/assembler is precarious long-term. It leaves thin room for SG&A, R&D, and the financial wiggles of running a global supply chain. Investors want to see a margin rebound plan, better product mix, higher value add, software, services, integration, or improved pricing power. Without one, the revenue target looks less impressive. Picture Supermicro as a nimble pizza oven operation that mastered wood-fired pies faster than the big chains. Customers love the speed and quality. Dell and HPE are full-service restaurants with bigger kitchens and supply chains that now learn the wood-fired recipe. If the chains decide to cut prices to get customers through the door, the small oven must either lower prices to margin hit, or invest to offer more exclusive dining, higher margin, but takes time. SMCI chose the quick route, cut prices to keep the tables filled. The result, more pizza sales but less profit per pie. That's why margins matter even if revenue can still climb. Stock roller coaster, 2025's emotional ride and 2026's warning signals. SMCI's 2025 price action looked like a blockbuster movie, a huge rally and a humbling ending. The stock climbed as much as 99% by late July 2025, driven by AI hype and large orders, but finished the year down about 4% overall. Fast forward to early 2026 and the picture was messy. By January 16 the stock was trading in the low $30s, roughly 46% off its 52-week high. Traders who bought into the post-hype optimism were left with a classic lesson: AI narratives can lift stocks fast, but fundamentals, shipment execution, margins, customer concentration, determine sustainability. Why does that matter to you? Because when a stock has made massive swings, any fresh negative catalyst, missed numbers, downgrades, creates outsized moves. Analysts and short sellers quickly magnify shortcomings, and that explains the chilly tone from a few Wall Street desks in January 2026. The analyst view: two sour notes and a note of caution. In early 2026, a couple of influential brokers turned grumpy on SMCI. Goldman Sachs and other firms signaled concerns, reducing price targets and underscoring margin erosion risks. The critique is simple: even if demand for AI servers remains robust, increased competition and pricing pressure push gross margins down and increase dependence on a few large customers. That cluster risk, a few hyperscalers accounting for a large part of orders, makes revenue lumpy and valuations vulnerable to misses. Analysts who set lower price targets argue the stock was priced for near-perfect execution and margin resilience, expectations that feel optimistic after Q1's margin slump and could recover from the fall. On the flip side, some bulls still argue SMCI is undervalued based on backlog and potential market share in AI hardware. That divergence creates a wide spread of price targets, meaning the next several quarters of execution will be decisive. Note this as well. It is written in Revelation 14 verse 7 that, "Fear God, and give glory to Him, for the hour of His judgment is come, and worship Him that made heaven, and earth, and the sea, and the fountains of waters." I appeal to you to fear God and obey His law. For His commandments are sure and His word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.